Hello everyone. Welcome to Mom and Children Financial Literacy channel. In this video, we will be discussing digital money platforms. I especially want to discuss the difference between debit card and the credit card. The reason I want to have this discussion was because of one of my personal story. One day, I picked up my daughter from school. She asked me for a toy, which is about $100. I said, we can put it in our budget for next month or two, but we can't buy it today because it was not in our budget. But she disagrees and she said, Mom, if you have a credit card, you can just swipe the credit card. I said, but money on credit card was not free. You do have to pay it. She said, no, if you have a credit card, you can buy anything. A few days later, I encountered a very similar conversation with my 7 years old son. Then I started thinking, where did they learn that if you have a credit card, then you can buy anything? To them, money spent on credit card come for free. So I feel it is necessary for our children to have a clear understanding of a credit card and debit card. A debit card is a payment card linked to a bank account. Usually it is a checking account, allowing users to make purchases and withdraw cash with the funds directly deducted from the checking account. So the debit card or checking account is like a bucket where money is stored inside of it. In a bank account, there's usually a lot of cash flow activities. Cash going into the bucket is considered as inflow, like salaries and other incomes, and all the expenditures is the money outflow. Our inflow has to be more than the outflow to have money remaining in our debit card for our future spending. When you use a debit card, the money is immediately withdrawn from your linked bank account. For example, if you spend $100 in grocery store and we choose to pay this purchase with our debit card, then the bank will deduct the $100 from our bank account to pay for this purchase. Debit card can also be used to withdraw cash from ATMs. Same as the purchase, the amount of ATM withdrawal is deducted from the banking account immediately. Overall, the allowance in our debit card expenditure is the same amount of the money in the linked banking account. For example, if I have $2,000 in my banking account, then the maximum allowed expenditure from my debit card is $2,000. As I said, this account is serving as a cash flow account. For example, if I have a balance of $2,000 in my debit card account, and I get paid from my salary of $2,000 today, and then my rent payment is $800 due today, and I also bought $100 of a grocery, then my checking account balance will have $2,000 from the previous balance plus another $2,000 from the income, minus the $800 of a rent, then minus another $100 of a grocery. As a result, in today, my checking account balance will be $3,100. A checking account is a fundamental financial tool that provides a secure and a convenient way to manage your daily finances. Other than debit card, Check serve as another way of a payment. Both the checks and a debit card serving the same function. They all pay the bills. A check is a paper document used to instruct a bank or other financial institution to transfer funds from the payer's account to the payee's account. Essentially, it is a written order instructing a bank to pay a specific amount of money to a designated person or entity. Checks are commonly used for various transactions, including paying bills, making purchases, or transferring money. In my opinion, check is a representative of money backed by the fiat money in our checking account. But a lot of places like grocery stores do not accept the checks as they will have to deposit the check to their bank account to cash out the money. Only if there's enough money in the payer's checking account they can get their money. If not, it will just be a piece of paper for them. It has no intrinsic value. A check is a written, dated, and signed draft that directs a bank to pay a specific sum of money to the other person or entity. For example, John Smith paid the YC Daycare LLC $500, and it has a date and a signature. As the key concept that I want to discuss in today's video is the credit card. Credit card represents a claim on future payment, a borrowing capacity. A credit card is a payment card issued by a financial institution like a bank or credit union that allows you to borrow money to make purchases or withdraw cash. It essentially provides a revolving line of credit, meaning you can borrow up to a certain limit and pay it over time, with the interest charged on any outstanding balance after the due date. You use the credit card to pay for goods and services or get cash in advance. The amount borrowed is added to your credit card balance, which needs to be repaid. If you don't pay your full balance by the due date, interest will be charged on the remaining balance. Some cards also have annual fees or other charges. Many credit cards offer benefits like a cashback, reward points, discounts, or travel miles. And it is also a tool to build your credit if managed correctly, like paying bills on time, which is important for accessing loans and other financial products in the future. The balance on our credit card is usually a negative value, which means we owe bank a certain amount of money that I will have spent. Then at the end of each business cycle, we pay the credit card balance using money in our checking account. Then the money is deducted from your checking account. In this table, I summarize the differences in credit card and the debit card. So here the first question I have for my audience. Is there any money on the card? For debit card, yes. We spent money we have saved in our account, which is linked to the debit card. It is like a cash card. There's money on the card already. But for credit card, no, there's no money on the credit card. All expenditures made on the credit card is through borrowing from a bank. Usually no interest on debit cards as the money is in the flowing status. flow in and flow out in a short period of time. But if we overdraw money from a debit card or checking account, there is usually a penalty called the overdrawing fee. For credit card, since we are borrowing money from the bank to spend, we will need to pay it back to the banks at the end of each business cycle, usually every month. Then the second question for my audience, can we get rewarded for spending more money? To the debit card, usually no, but the credit card do provide rewards like cashback or points for travel, like we mentioned earlier. For example, if a credit card offer 1% cashback, that usually means if you spent $100 on your credit card, you will get $1 back. Then now my next question, since usually credit card means borrowing money from a bank to spend, why bank provide us reward instead of charging us interest for borrowing money from them? I will leave this question open and let my audience try to figure out the answer, or we can discuss this question again in the future videos. Using credit card has some other benefits like building credit, we mentioned it before. If you pay it back on time every business cycle. Well, debit card can help building credit. One personal story I want to share. When I first came to US for graduate school, I did not know how important credit is in this country. And borrowing money to spend is against my personal financial management concept. So I did not get a credit card. And I have been spending money from my debit card every time until one day I decided to buy a car and I need to take a loan. But I was refused by the auto dealer to provide me a loan because of the lack of a credit history. So it is important to build a good credit history in the United States of America. All card expenditure has a limit. Debit card allowed spending limit is the amount in your bank account. While on credit card, usually bank will provide you a credit limit based on their evaluation of your income and the credit history. So in summary, the fundamental differences between debit card and a credit card is that debit card is to spend the money you have saved up on the card, like a cash card, while credit card is to borrow money from bank to spend and pay it back at the end of each business cycle. Another tool from a banking system to manage our finance is a saving account. Both the checking and saving accounts are fundamental banking tools to store your money, but they cater to different financial needs. The purpose of a checking account is for day-to-day spending and managing expenses, while the purpose of a saving account is for storing money for future goals. Checking account is usually very easy to access through debit card expenditure, ATM withdrawals, checks, and online payments, but saving account is less accessible. The checking account usually provides no interest, even if there's any. It is usually very little, while saving account usually provides interest. The interest rate varies from bank to bank, but it's usually lower rate than other options like CDs or bonds. Checking account usually has no limitation in the number of transactions and the amount of transactions as long as you have enough money in the checking account, while saving account has limits on withdrawals or transfer per month. If exceeded, some banks may charge fees. Also, like CDs and other fixed income investments, interest earned on saving account is taxable. Checking account is usually the best option for paying bills, making purchases, and other frequent transactions, while saving account is usually best for emergency funds or other specific goals. Though saving account is a better option for money accumulation, there's other factors that we need to consider. For example, Federal Deposit Insurance Corporations called FDIC usually only insures up to $250,000 per ownership. Both the saving and the checking accounts have a phase, but banks usually offer ways to waive those fees, like a certain amount of direct deposit every month. You will need to discuss with your bank on the specific conditions. Many individuals benefit from having both a checking and a saving account, often at the same institution, to separate funds for daily spending from money intended for savings goals. In summary, checking account balance is usually the same amount as the debit card spending limit. It is serving as our cash flow account, including money inflow and outflow. Credit card spending means borrowing money from bank to spend and paying the balance back to the bank at the end of the business cycle, usually every month. If not paid back in full amount, the interest rate is usually very high. Another financial tool is a saving account. It serves the same function of accumulating money for future goals like piggy banks. When needed, we can fund our checking account with a saving account. Thank you for watching my video. Let's stay together and grow financially smarter and smarter. I'll see you in my next one.